It is widely studied and acknowledged that the economy moves in cycle. The business cycle is defined as a natural fluctuation of the economy between periods of expansion and contraction. Following this business cycle, specific industries can financially outperform or underperform at different phases. For example, consumer discretionary sector tends to outperform the rest during the earlier phase of expansion as consumers have more spending power. On the other hand, during a period of contraction, more price inelastic industries such as healthcare and utilities are likely to perform better. One investment strategy that leverages on the business cycle is ETF sector rotation strategy, where the investor increases the allocation of investment portfolio to sectors expected to outperform because of cyclical trends, and decreases the allocation of portfolio to sectors that are expected to underperform. Despite its increasing popularity, implementing ETF rotation strategy can be challenging. Firstly, difficulty in identifying the market cycle and inflection point. This is because cycles tend to vary in duration and hard to identify. Secondly, difficulty in optimizing portfolio rebalancing. Existing ETF rotation strategies implement static rebalancing that may make suboptimal trading decisions that are independent of market behavior. Thirdly, difficulty in optimizing portfolio construction. To maximize the benefits of sector rotation, there needs to be a scheme on how should portfolio be built. To answer the three problem statements, cycle-based ETF rotation strategy with dynamic rebalancing, in short, SASDR, is proposed. SASDR provides an end-to-end ETF sector rotation scheme from portfolio construction, cycle identification, and portfolio rebalancing. Let's go through the key components of SASDR one by one. Firstly, to identify cycle inflection points effectively, a dual reinforcement blending agent is proposed. The agent retracts the data using momentum, and next, it uses moving average to smooth the data. The value of cycle duration is also tuned to fit different sectors' characteristics more closely. By implementing the dual RL agent, accurate tuned cycles are obtained. Further analysis of the result also shows high consistency and robustness. Secondly, to address the issue of rebalancing, dynamic rebalancing scheme using reinforcement learning agent and neural networks is proposed. The basis of the rebalancing scheme is to maximize return from rebalancing by selling ETFs at the peak and buying ETFs at the trough of the cycle. The proposed scheme uses inflection points predicted earlier as the rebalancing trigger points. At each inflection point, the agent summarizes the market by studying the historical price changes of the different assets. Finally, the agent assigns portfolio weight based on the upside potential of each portfolio constituent. The upside potential is estimated using long-term, medium-term, and short-term gradients as well as the average drawdown. The proposed scheme is benchmarked against S&P 500 and other rebalancing schemes. SASDR outperforms the benchmarks in a backtest period of 10 years. It is able to outperform the S&P 500 index by an average of 3.09%. Thirdly, to maximize the performance of SASDR even more, a portfolio construction scheme is also proposed. The hypothesis is that asset correlation between ETFs in a portfolio is significant in determining the performance of SASDR. Using maximum reward reinforcement learning agent, several experiments are conducted. The experiments show there is a trend that the higher the correlation, the higher the optimal portfolio size. This can be seen in the higher rewards obtained in higher portfolio sizes for a portfolio with higher correlation. To verify these results further, an incremental reward analysis is conducted. Most of the incremental reward has a clear maximum point with clear increasing and decreasing trends towards the maximum point. This further points towards approving the hypothesis. Further studies on the performance of SASDR can be done by implementing the strategy on ETFs on other markets outside the US. The application of SASDR can also be extended to other asset classes, such as public equity, using the same cycle-based sector rotation principle to evaluate if it is translatable.